Last year, startups collectively raised over $156 billion from investors. In this video, I'm going to share with you 10 of the biggest mistakes that angel investors make. At the end of the video, I'm also going to share a few different websites that you can find some of the best startups to invest in. So make sure you watch this video until the very end. Now, most of that $156 billion I mentioned came in the form of angel investment, venture capitalists, private equity funds, and of course, banks. This video, I'm specifically talking to those who are interested in investing in startups for either the first time, or maybe you've invested in a handful of startups and you'd like to learn more, or you're a VC or a budding VC and you want to learn more about the angel investor perspective. You might also be an entrepreneur looking to raise capital for your own startup. If you're interested in learning more about how to invest in startups, make sure you check out a video I did on that topic specifically, one of the most popular videos on this channel, and I'll make sure it is linked down in the description below. If you're wondering who is this guy, what's up? My name is Ferris. I'm the co-founder and CEO of a global technology and media company with a distributed team that spans over 10 time zones. I've raised capital for this business through venture, angel investors, institutions, equity crowdfunding, grants, and winning a number of different pitch competitions for the business. I'm also an investor, and I've invested in a dozen different startup companies in just the last year, actually, and I'm familiar with the perspective of what it takes to not only raise money for a startup, but also invest in a startup. Before we get started, a quick disclaimer: this video is for entertainment purposes. I am not your financial advisor. Investing has risks, so you should always do your due diligence before making any investment decision. I know that seems obvious, but we had to say it to get out of the way. Now, the first mistake that investors make is investing in the first deal that they see. This is a huge problem. Here's a quick stat. In the United States alone, 565,000 businesses are started every single month. Now, 500,000 startups being started in a month, not all of them will raise capital. So the number is a lot smaller, but still, if 1% of those end up raising any kind of capital, that's 5,000 new startups every single month in the United States alone. Now, that's in addition to all the companies that have been around for a while and now they're choosing to raise capital at some later point in time. Most don't start raising on day one. So there are so many investment opportunities out there, and the biggest mistake that you can make is to see something for the first time, fall in love with it, see the founder, watch the promo video, look at the pitch deck and be like, this is the greatest thing since sliced bread. This is the next Tesla, the next Facebook, the next Google. I'm going all in, YOLO. Do not do that. That is not a very smart investment process, because if you spend a little bit more time in the industry, looking at companies, looking at these websites, you're gonna see that there are so many different investment opportunities, and you don't wanna fall in love with the first one that you see. Here's another interesting fact. Of these startups that raise seed funding, now last year I believe the average seed round, one of the first rounds in a raise, was $2.2 million last year, I think. Only 1% of those will end up hitting a $1 billion plus valuation, unicorn status. So that's not to discourage you from making an investment. Just know that just because you fall in love with this one company and you think it's gonna be the next Facebook, it's probably not, and you want to make sure you invest the time. We'll talk about due diligence and how you find those startups. Put in the time up front so you don't fall in love with that first deal. But you know what you can invest in? Invest in the like button. If you enjoyed this video so far, make sure you smash the like button, subscribe to the channel. I heard the ROI on that like button is you invest one like and you get 10 tips. Pretty good ROI. The next biggest mistake is not understanding the business model. This is huge. Obviously, you need to understand how the company is going to make money. And if the company does not make money, that's actually not necessarily a problem if they're pre-revenue, but they need to have an idea of how they're going to make money in the future. Is it going to be an e-commerce business? Is it advertising, software as a service, subscription, selling data, analytics, whatever? As long as there is a good idea and ideally traction to show for that business model, then you're gonna be on the right track. You also need to make sure there's a vision for the business. So maybe there's no business model today, but they know that by hitting certain milestones, the team will be able to implement a certain business model in the future. Now, a huge red flag is having multiple business models at the same time, meaning multiple streams of revenue and really dividing the focus of the company at the earliest stage on so many different things. Now, you might be thinking that's counterintuitive. More streams of revenue means revenue diversification. That's better for the business, right? I would say that's actually, it couldn't be anything further from the truth. If you think about any successful business, for the first 5, 10, 15 years, really focus on one specific channel of revenue, one business model. You might be thinking, well, Amazon has, 12 business models or something like that. Yeah, and Amazon's been around for almost 30 years. All the great companies start with one business model because it allows you to focus on one specific thing, solving one problem for one type of customer, and then you can scale out from there. So if the founder or CEO says, well, we're gonna have a subscription here, then we're gonna have advertising, we're gonna get sponsorships, and then we're gonna launch a merchandise site. No, that's not how you start. It comes later. And if you're investing in a later stage company, you're probably not watching this video, but then at that point, it might make sense to start diversifying the revenue. Third biggest mistake is investing outside your domain knowledge. You really need to look at companies in the space that you know. Invest in what you know. It gives you greater conviction to make the investment, and you have a better gut feeling. This is part art and part science. You want to make sure you have that gut feeling. So if you're into technology, look at tech companies. If you're into fashion, look at companies that are building a brand. If you're in the financial services area, look at fintech companies. If you know how to sell stuff online, look at e-commerce. Make sure you only invest in things that you know, because it takes you longer to do due diligence in an industry that you're unfamiliar with. So keep that in mind. The fourth biggest mistake is not hearing from the CEO or the founders in the due diligence process. In a startup, the most important character is the CEO. It's the founder, it's the founders, it's the early team, because at the earliest stage, the team is the business, right? This isn't a publicly traded company where you can theoretically replace the CEO and the business still works because there's 10,000 other people. In a startup, you're talking about investing in 2, 3, 10, 30 people. And so the vision of the CEO and their ability to communicate what they're doing, their ability to execute, is actually more important potentially than everything else, because you're investing in the founder, in the founders at the earliest stage. So if you don't hear from the CEO or founder, maybe someone else is raising money on their behalf. Maybe they're hidden and they have some kind of a shell business going on, or someone else is really pitching for them. That's a huge red flag. You want to be, and you don't have to speak to the founder, one-on-one and take him out to coffee. This is the 2020s. There's the internet. You can find them in an interview. Most likely they've spoken on a podcast. And if they haven't, that should also raise some red flags. Is this person an industry leader if I can't find anything about them when I Google their name, right? Something to think about. The fifth biggest mistake is investing out of FOMO, fear of missing out. This is an acronym that cripples any type of investor, really, whether you're in the public market and just in life, quite frankly. There's a good expression, the blind follow the blind. So just because Jason Calacanis or just because Sequoia invested in something means that you need to invest in it too. If a notable angel investor or a venture capitalist has invested, it might be a good leading indicator that the investment is good because they have teams that they do due diligence on. But it doesn't mean that the investment is a good investment, okay? So make sure you do your own due diligence, invest on your own conviction, and if there is a deadline to invest in the company and the deadline comes and goes, don't feel bad that you missed that opportunity. Like I said, there's 565,000 new businesses started every single month in the United States, right? If you feel like you missed the next Uber or Facebook, there's gonna be another one of those. And most likely that was not the next Uber and Facebook. So have your own conviction and do not invest out of the fear of missing out. Sixth biggest mistake is not understanding the terms of the investment. I would actually say, from my personal experience, most angel investors, heck, VCs too, have no idea how the terms are actually structured in a deal. It's kind of mind-blowing, actually. So this means the type of investment, like the investment vehicle, is it a safe, convertible note, equity, revenue share? Are there dividends being paid out or something like that? And not just what type, but the terms on the investment. So what are the terms of the convertible note? And then most importantly, how they actually convert into equity. So what is the valuation cap, the interest rate, discount? What are certain triggers, like what is the amount raised that is required to trigger a conversion? A lot of these things, most angel investors have no idea what I just said. So I'm gonna make some more videos explaining these things because these are really important, because if you're putting in $1,000, $10,000, or $100,000 into a company, you need to know the terms that you're investing in. Not only do you need to understand the terms and how they convert into equity or at a public offering or an acquisition, but you should also not sign off without legal consult. Now, if you're an experienced angel investor and you do this all the time and the investment round is being done online, you probably don't have any negotiating power anyway in a lot of these things. But if you're investing in something that's not online, it's kind of like under the table, closed doors. I shouldn't use under the table because that sounds illegal. If you're doing something that's not an open public offering, that's online, the terms are public, you want to make sure you're consulting with legal or be a lawyer yourself so you can actually look at the deal and make sure you understand what is going on, what you're signing, and where, quite frankly, you're wiring your money to. The seventh biggest mistake is not doing due diligence. Now, I mentioned the concept of doing research many times already, and it should go without saying, but you want to know who you're investing in, right? So look at your references. You can call, email, LinkedIn stock, look at Twitter, look at Instagram, the CEO, the founders. You want to understand the psyche of the person that you're investing in who's going to lead this company. Also, when you do references, not only is it the founders you're looking at, but you can reference other founders who might know that founder. You might reference the other investors in the deal. You might do an interview on customers in the industry. Or if you don't really understand the industry fully, you want to understand the industry key players and people who might become potential customers in the future. So make sure you do your own due diligence, not only on the structure of the deal, but on the people who are actually making the deal happen, the other investors, the founders, the customers. Number 8, investing without a lead. Now, this is a little bit controversial because this sort of goes against the fear of missing out and following just because someone else invested. But at the same time, if you're not the lead investor, meaning you're the one who's setting the terms, leading the charge on the investment round in terms of the amount of capital that you're putting in or something else, you might be that person to have that conviction. But if there's no lead and basically you're the only one who's committed, that might be a problem, a signal, because the founders might not be able to close the round. You might need to raise $500,000 and you're putting in only $10,000 or $50,000. Where are they going to get the other $450,000? They can't really do anything with your $50,000. They need $500,000 in the deal. They being the entrepreneur, the CEO. So the speed to close becomes a lot better and you have more conviction when there is a lead investor. That could be a venture capital firm. It could be an angel investor who is the lead. Or if you're doing an open public offering, there are a few other bigger fish in the sea. If you have full conviction, maybe that's you. Maybe you are the first investor, the first money in, but you better have good conviction. Otherwise, you might be left out to dry and really the only investor because the entrepreneur was able to convince you to put your money into that company. So it says something not about the entrepreneur, but about you in interpreting that company. Again, if you strike big and you win because you were the first money in, you will be rewarded for it. Otherwise, you will pay the price. Now, the 9th biggest mistake is not having enough diversification in this alternative asset class. So I use some big words in there. Let's break it down. In any type of investment portfolio, again, this is not financial advice, do your own due diligence. However, it is a relatively wise thing to have, 1 to 10% of your portfolio of assets of net worth in some type of an alternative investment. Maybe that's a little bit higher, a little bit lower. Alternative investment could be something that's not real estate or the public stock market like a Facebook. Maybe you've invested in cryptocurrency or startups, early stage private companies would fall into that allocation. Now, of that 10% of your net worth, let's say you have $1 million. So you want to have $100,000 of it invested in these alternative assets. It's a lot better to have conviction behind a number of startups than to have, only one investment. Because if you go all in and that investment fails, remember, only 1% of the deals will actually get to that unicorn status. So it's really important that you have conviction behind a handful of companies, not just one company. So don't go all in on one company and put all your money in. I'll put $100,000 in one company. If you only have $100,000 to invest, that should be broken up into 10, 15, 20, 30 startups over a number of years. Here's an example. If you have $10,000, you have $10,000 you want to invest in a 1-year window, maybe it's part of your income or something like that. It's a lot better to invest in 10 startups, $1,000, rather than have so much diversification that you invest in 100 startups, $100. And so you might be thinking, well, if you invest in more startups, you have more likelihood of hitting a home run, a big winner, a super high ROI. Yeah, potentially, but you're also not going to be able to do any of the other things that we mentioned, the due diligence, your homework, understand the industry, and have conviction behind the founder and the startup if you're investing in 100 startups in 1 year, right? Now, after 5 to 10 years, you might have a portfolio of 100 companies that you've invested in because you put in the time and the work to actually understand what the heck that they're doing, and you have conviction behind it. So in this example, $10,000 is much better to have 10 invested, $1,000 versus 100 investing. Now, if you're wondering, where the heck can you invest only $100 or $1,000? Well, we're gonna get to that at the end of the video. We're almost there. A few different sites that you can invest as little as, I think, $50 in private companies. So number 10 is the lack of a long-term horizon. I already alluded to this, but basically thinking that, oh, well, if I go to the stock market and I go invest in Apple stock and then it goes up 20%, I can pull out my money and I made big. That's not how investing in private companies work. Oftentimes you're investing in the long run and you're just gonna have anxiety if you can't pull your money out, because you can't. In a startup company investment, your money's going in, you gotta believe in the long-term vision of this company, because most likely you're never gonna see that money again unless the company goes public, is acquired by another company, has a private equity buyout or some type of secondary much in the future. Thinking that any of those things will happen within a year of your investment or 2 years or 3 years or 4 years is not really a wise investment strategy. So make sure you have a long-term horizon. And also, if you're a more sophisticated investor and you have more capital to deploy, especially at the first round or later on, the entrepreneur might ask for follow-on financing. And if you have conviction behind this company, you want to be in a position where you can invest again if you have that kind of capital allocation. So you invest $50,000 in the first round, they're raising again, now you want to invest $100,000 or $200,000, or you want to maintain your ownership position in the business. You're not going to be able to do that if you have a short-term horizon. So think about it from that perspective of follow-on potential investments. Have a 10-year plus horizon. That way you won't get stressed with the ups and downs of what's going on, building the startup behind the scenes, and you can have that long-term perspective. Now, I know I alluded to a few different platforms. Here are a few platforms that I recommend you can check out. Some startups that are private, going public for a month, 2 month, 3 month, half a year or something. The first one is called WeFunder. I've actually raised over $500,000 on this platform specifically. Great equity crowdfunding site. It's the biggest by market share. Another one is called Republic. This one's great. They'll have a mobile app as well. There's another one called Start Engine. This one's really good too. And there's a handful of others out there. Make sure you're investing in a legit platform. These all have tons of different startups that are raising at any given moment. Different industries are all on there. There's also a few others called Angel Lists and Seed Invest. Now, some of these require much higher investment minimums, and some require you to be a professional investor, meaning you have a net worth over $1 million, excluding your primary residence, make over $200,000 per year or $200,000 per year in income. So you might not meet those requirements. If not, no problem. Check out the other equity crowdfunding sites. I'll also be doing a deep dive on each of these platforms and making an investment with my own money into each of these to show how they work. So stay tuned for that. If you guys made it to this part in the video at the very end, thank you so much for your time. I really appreciate it. If you're interested in building startups, investing in startups, or entrepreneurship, or what it takes to build a global technology and media company, make sure you subscribe, invest in that like button if you haven't already. Wish you guys the best. Let me know in the comments any questions that you have, and keep hustling.